Excellent. Thank you so much, Rob, for the introduction. Very excited to hear your guys' comments on this paper. I should just mention my co-author, Ana Maria. She's at the Federal Reserve Board, so nothing I say today should be taken as representative of the views of the Federal Reserve Board or the Federal Reserve System. So as we've been talking about today, this is no surprise to anyone. We've seen an unprecedented rise in climate-related property damage over the past few decades. And yet we also see at the same time that economic activity in the riskiest areas continues to grow. So we've seen more and more migration into coastal areas, especially during the recent pandemic. But this has been a broad trend even beyond that. And the question that we're interested in is how much of this is because financial markets are not providing the right incentives. And so what we do in this paper is we think about or we identify key frictions in how insurance and mortgage markets are interacting with each other. And we're going to show that there are distortions in who's bearing the risks and how those risks are priced, but which in turn is going to affect how much credit is flowing to risky areas and helping to create some of this misallocation of people to areas. So in terms of background, physical climate losses are going to be distributed through connections in the mortgage market. So there are a few different entities that play an important role in this space. So the first is the household. The household is exposed to physical climate losses because the household lives in that particular home and is exposed to the loss through their home equity in the home. The second is going to be the mortgage lender. So houses that are buying homes using mortgages for the most part. And so banks and mortgage lenders also bear direct exposure to physical climate losses through their lending decisions. Of course, lenders require that households buy property insurance in order as a condition of the mortgage. So property insurers are going to bear direct exposure to physical climate losses because they provide insurance against this property damage. And then lastly, in the United States, we have the outsized presence of the government in mortgage markets through the entities Fannie Mae and Freddie Mac, the government-sponsored enterprises. So if mortgage lenders choose not to retain the mortgage on their balance sheet, if they choose to sell it to the government, then the government is going to bear exposure to physical climate losses through the GSEs. So we're going to try to trace the distribution of physical climate losses through the mortgage market to understand at the end of the day who's holding the bag. And the way we're going to do this is we're going to link county level property insurance data to mortgages data for Florida. And we focus on Florida for a few reasons. What happens in Florida can be a bellwether of what's happening to markets in other states. Florida is sort of the first time we can see some of these trends. And Florida offers us granular data that we can analyze. So for the regulators in the room, if you want to understand this issue, providing data to academics is a great way to do it. That's my pitch. And so Florida actually does this for a small period of time that we can use. And the key friction we're going to focus on is how the government-sponsored enterprises, Fannie Mae and Freddie Mac, monitor and assess insurance companies. And we're going to argue that the way in which they do this is miscalibrated. They don't actually understand the risk that they're taking on. And they are taking on insurance from very risky insurers without pricing it. So that's the key friction we're interested in. So the main findings of this paper are that we're very worried about solvency in the Florida insurance markets. Bill said earlier, there's a financial regulation issue in Florida. I wholeheartedly agree. I don't know where he is. And I'm glad to hear that someone in industry said it, not me, because they were saying it too. Fragile insurers with inflated financial stability ratings are now dominating insurance markets in Florida. And the government-sponsored enterprises, Fannie Mae and Freddie Mac, are more exposed to these fragile insurers, due in part to strategic behavior by lenders. So we're going to show that mortgage lenders are aware that there are good insurers and bad insurers. They're limiting their exposure to bad insurance, and they're offloading mortgages that are exposed to bad insurers to the GSEs. We're going to show the solvency of the insurance company matters. So fragile insurers are going to amplify mortgage delinquency outcomes after storms. We see borrowers defaulting on their mortgage at the same time that their insurance company goes insolvent. And so what this means is that there are large taxpayer exposures and externalities coming from solvency risk in the insurance market. And it's not from the way we're used to thinking about. We know about state guarantee funds. We know about subsidized flood insurance. This is going to be another way in which the government is bearing exposures to this risk, to these climate risks. And the last piece is that we're going to argue that GSE policies are distorting adaptation. It's leading to too much credit supply in high-risk areas. So there's a bit of an inefficiency that's coming from the way in which the GSEs are thinking about these risks. So I'll start with some institutional background and data, and then there are three parts to the paper. The first is insurance market trends. This is just broad descriptive statistics on characteristics of the Florida insurance market. The second part is going to focus on mortgage securitization and the linkage between what's happening in insurance markets and what's happening in mortgage markets. And the last piece, we're going to put these results together and think about broader implication for climate, the distribution of climate risk in the economy. So this is a little schematic to help fix ideas. So if you think about a property and exposure of the property to climate risk, the first thing that probably comes to mind is that there's a person that lives in the property and there's a person that lent to that household. So the first sort of key entities are the household and the mortgage lender. Of course, the lender knows that physical climate events are a big risk to the value of the mortgage. So what they do is they require that the household buys insurance. So the household pays some premium to the insurer, and the insurer pays out in the event of some kind of a natural disaster loss event or a storm. So insurers are playing this very important role in mortgage markets. They're helping to protect the collateral value of the house because this property is what's securing the mortgage, but they're also helping to prevent default because a household is much less likely to default if they're able to use insurance proceeds to rebuild a home. So insurance is helping to improve the default risk of the mortgage directly. So in a world where, in the world that we're living in the United States, many mortgages are sold to the government through Fannie Mae and Freddie Mac. And the GSEs know that insurance plays this very important role. So they have requirements for what kinds of insurers they're willing to accept. And the way they do this is they rely on insurance rating, so rating agencies. So they're saying, we're allowing you to securitize this mortgage with us. We'll buy this mortgage from you, Bank of America or Wells Fargo or whatever. But the property insurer that's providing the insurance has to have a high enough financial stability rating. So that's how they're assessing whether insurance companies are sort of going to pay out or not. They're relying on these ratings. So if the rating is high enough, the bank can sell the mortgage to the GSE. And if the rating is not high enough for that property insurer, then they can't. So of course, this creates incentives to get property insurance from highly regulated or highly rated insurance companies. So as I mentioned, homeowners insurance is mandatory to obtain a mortgage. It's for all households. It's not just households in flood zones or high risk areas. And the GSEs, Fannie Mae and Freddie Mac, they don't adjust their pricing based on insurance counterparty risk. So there's one fee that you have to pay to securitize your mortgage with the GSEs. That fee varies based on other characteristics like the borrower's FICO credit score and the borrower's loan to value ratio, but it does not vary by the strength of the insurance company. And the insurance company, and the rating agencies that are accepted by Fannie Mae and Freddie Mac in our period are AM Best, S&P, and Demotech. So we're going to call AM Best and S&P traditional rating agencies because they've been around for, so AM Best has been around since the 1800s and S&P has been around since the 70s. And Fannie Mae requires a B or higher rating from AM Best or triple B or better from S&P. And Freddie Mac requires B+ or higher from AM Best or in triple B or higher from S&P. So those are maybe the names you're more familiar with. In Florida, there's this third rating agency that plays an extremely important role called Demotech. We're going to refer to Demotech as an emerging rating agency. They were created in the 90s. And for a property insurer to be GSE eligible, they have to have an A or higher rating from Demotech. So we're going to use the lens of the GSEs to classify all property insurers that operate in Florida. So we're going to call traditional insurers the ones that are rated only by AM Best and S&P, AM Best or S&P. We're going to refer to insurers that have a Demotech rating as Demotech insurers. And then lastly, we're going to refer to the state residual market citizens as citizens. That's the third group, the state insurance company of last resort. So with this categorization, I'm just going to show a time series of who's underwriting in Florida. And you can see that the Demotech premium share has grown dramatically. From being negligible in the 1990s, they're now the dominant provider of insurance in Florida. If you look at the traditional insurers, they sort of peaked right around 2007, and their market share has been declining. And then finally, if you look at Citizens, it's been going up and down, partly related to policy, which I'll talk about. So these Demotech guys are now dominating. That's true on a statewide basis, but that's also true if you look at the histogram of counties. So if you look at 2009, this is the fraction of premiums that are underwritten by Demotech insurers. There's much more of a distribution in 2009. But if you look at the latest data we have in 2018, there's much more skewness. So we're seeing counties where more than 70% of insurance premiums is provided by these Demotech insurers. So these guys are dramatically, their market share is dramatically increasing. So then the next question is, well, what are their financial characteristics? And so if I had more time, I would go through each of these variables in detail. But basically, we argue in the paper that the characteristics of these Demotech insurers is very, very bad. They're very, very risky. So what do we mean by that? We show in the paper that they underwrite in riskier areas. They have far more concentrated exposures than the traditional insurers. So they're less diversified geographically. They're less diversified geographically. They're less diversified in terms of their product line. So they almost entirely operate in homeowners. They don't have other product lines to diversify. They operate in groups that are smaller in size. So they have fewer, they're operating in fewer big groups. They're also less capitalized, so they have far lower capital ratios than the traditional insurers. And they rely on riskier reinsurance relationships. So for that, what we mean is most of them rely on a single reinsurer, so they have concentrated reinsurance relationships. They're also relying on reinsurance from providers that are not as highly rated as the traditional insurers. So on basically every measure of risk that we looked at, these guys were performing worse. And what was most important for us is that they tend to operate only in Florida. So about 70% of them were only operating in one state. And then even within Florida, they weren't so geographically diversified across counties. So they're on all these ex ante measures, they're riskier, but they're also riskier on ex post measures. So what do I mean by that? We can look at actual liquidations and insolvencies in Florida. So we do this from 2009 to 2022. And we find the shocking result that every insurer that went insolvent in Florida during this time period is what we would have called a Demotech insurer. And roughly 20% of Demotech insurers went insolvent. So these are all to say that we're worried about the fragility of the insurance markets in Florida. And but at the same time, if you think about how were they rated, you look at the risk histogram or the ratings distribution, you see that all of the insurance companies with the Demotech rating, or nearly all, there's a small group here, 99% of them had an A rating or higher. So what does that mean? That means all of them met the GSE eligibility thresholds, regardless of the fact that they were worse on all of these other dimensions. So the next question we ask is, if these guys had been rated by a traditional rating agency, what would their rating have been? Would their rating have been high enough for them to meet the GSE's eligibility threshold? So the way we do this is we do a counterfactual ratings analysis. We develop a ratings replication model for AM Best, and then we try to predict what the Demotech ratings would be based on that replication model. The circles here are the ratings, the average ratings that we estimate from AM Best. And the confidence interval here is a 95% confidence interval. So I know this chart is a bit confusing, but the lower you go, the better the rating. So what does this mean? That means all of these guys we estimate have ratings that would not be GSE eligible on average. There are some guys that are good, but the majority of them aren't. So if we put numbers on this, 21% of these Demotech insurers would not have met Fannie Mae's eligibility threshold if they were rated by AM Best. And we suggest that 67% would not have met Freddie Mac's threshold if they were rated by AM Best. And if you look specifically at the subset of insurers that went insolvent, we find that none of them would have been eligible for the GSE securitization prior to their insolvency. In other words, it was knowable. You could tell from their financial characteristics that they were very risky and likely to go insolvent. That's the takeaway. So all of this is to say that private insurance markets in Florida may not be as reliable as you think. So the next question is, in a world where the insurer goes insolvent, who bears the loss? And so for that, we need to look at mortgage securitization, who is actually owning the mortgages and who's bearing the risks. So the way we do this is we do a simple cross-sectional correlation. So this variable is the share of premiums that are underwritten by these demotech insurers. That's our independent variable. And our dependent variable is just a share of mortgages that are sold to Fannie Mae and Freddie Mac. So what do you see here? You see here with no additional controls, just the pure correlation, places with a higher demotech footprint are also likely to have a higher share of mortgages sold to the GSEs. And that holds regardless of whether you have a year fixed effect or county fixed effect or both. And so that tells you that the GSE's market shares are strongly co-varying with these demotech shares. So that means the GSEs are the ones that have the most counterparty risk exposure to these fragile insurers. But there are two explanations for why that might be the case. Why are the GSEs more exposed to the fragile insurers? The first could be what I hinted at already, that there is a sort of strategic behavior happening from the banking system. Lenders are offloading exposure to bad insurers to the GSEs because they don't want to hold that risk themselves. So that's what we're going to call the causal effect of insurance quality. The second is borrower selection. So what does that mean? That means that maybe has nothing to do with the insurance company at all. Maybe it's just the case that higher risk borrowers tend to buy insurance from higher risk companies. And so lenders are just doing the normal thing where they're trying to offload exposures to high risk borrowers. And it's not something about the nature of the insurance company. And there's actually a reason to be concerned about the second explanation. So what we've done here is we've organized the policies by the average coverage per policy. So this is $300,000 per policy. And then we look at the share of insurance provided by demotech versus traditional in that group. So you can see here for the groups under $500,000, these are all likely to be conforming borrowers. Oh, wow. Okay. Okay. So demotech people dominate in this conforming loan space. So the way we do this is we're going to exploit this natural experiment coming from a policy in Florida to depopulate Citizens' balance sheet. So what is this policy? Citizens is a state insurance company. Every so often their balance sheet balloons, usually after large hurricanes. And Florida does not like the fiscal risk associated with a large state-run insurance company. So what do? They force Citizens to basically work with private insurers to have the private insurers assume the policy. And so what's nice for us is that the demotech insurers are dominating the depopulation program. 39 out of 40 insurance companies are these demotech guys. And in fact, they tend to be the worst quality of the bunch. Their average AM Best rating, according to our analysis, is a C++. So Citizens is giving policies to the lowest quality demotech insurers. So why is this useful for us? What we have is we have a shift in insurance from a high quality insurer, which is Citizens, to a low quality insurer, one of these demotech guys, for the same borrower. So we're fixing the borrower and we're looking at a change in the insurance. And then we look at what happens to the mortgage. Are they selling the mortgage to the GSEs or are they keeping it? I'm going to skip this because of time, but basically the headline is we see that the banks are much more likely to sell eligible mortgage to the GSEs following a depopulation. They're offloading this risk. So this is unlikely to be driven by changes to the borrower that's happening at the same time because the depopulation schedule is set by the state and is set in a way that is exogenous to the underlying characteristics of the borrower. So this is the evidence that we use to suggest that banks are behaving strategically and offloading this risk to Fannie Mae and Freddie Mac. The last bit is, okay, so how much does this matter? Fannie Mae and Freddie Mac have a lot of mortgages. Maybe there's no effect on mortgage default. So that's exactly what we're going to look at. So for this, we're going to look at the effect of Hurricane Irma, which hit Florida in September 2017. It caused $50 billion in damages and also led to insurance insolvency. we're going to do the simple exercise of looking at what happens to serious mortgage delinquency. So this is a mortgage borrower has missed more than 3 months of their mortgage payment. So this is significantly predictive of that borrower ending up in default. So 90 days or more delinquent, foreclosure, or REO. That's going to be the left-hand side. And we're going to look at the independent effect of the storm. So we have data on total property damage from Sheldon. And we're going to look at additional amplification that comes from the fact that that particular county is exposed to insurers that went insolvent. So this is going to be, this beta 2 is going to be the amplification coming from insurance market fragility. And just to show you overall mortgage delinquency, if you look in the pre-period before Irma, it's about 1.5%. And you see after Irma in the exposed counties, delinquencies shoot up dramatically. And it actually shoots up for both groups, even groups that are not directly exposed to the storm. So some of this effect is going to be coming from the fact that insurers went insolvent. So what do we find? If you look at the sixth column, if you look at the fifth column, this is limiting to 1 year before and after Irma. You see that there's a large direct effect of the hurricane on mortgage default. But you see that the effect is really amplified in those counties that are exposed to the insolvent insurers. And so how do we benchmark this magnitude? We get that on average, delinquencies increase by 20 basis points in your county that experience an average loss. But for counties where insurers are more fragile, delinquencies increase further by 26 basis points. Is that big? Is that small? Well, the average delinquency rate is about 1%. So a 25 basis point increase in delinquency is huge. It's huge. So how should we think about this quantification? The way we do this is we think about what share of the GSE's losses are coming from climate. We use the parameters that we estimate from Hurricane Irma to benchmark this number. And so what we get is that on average, climate-related losses account for about 10% of the GSE's losses. That's including the direct effect of the storm, as well as the amplification from insurance. The independent effect of insurance is about 5%. So 5% of GSE losses from climate are coming from the fact that they're relying on risky insurance. We also have this result that mortgage lenders are more likely to deny, mortgage lenders are more likely to deny jumbo loans in places that are more exposed to the fragile insurers. That's what this coefficient means. They're 5 percentage points more likely. So jumbo loans cannot be securitized, conforming loans can. So for the mortgages where the lenders know that they can never sell it to the GSEs, they're not going to accept crappy insurance. So what does that mean? That means all of the crappy insurance is going to the government. So to conclude, we think that the ways in which the GSEs are monitoring counterparty risk in insurance markets is miscalibrated, and it's helping to lead to the growth of fragile insurers. The GSEs, and that means all of us as taxpayers, are exposed to large unpriced exposure to climate change due to this insurance counterparty risk. And we also see that this is leading to a distortion in that there's an expansion of credit supply in high risk areas. And the next thing that we're working on is if the GSEs wanted to formulate an optimal policy, what should they do? And we think that they should actually price in the counterparty risk into the guarantee fees. So we're working on determining what that number should be. So thank you so much.
Time for a couple questions.
Right. I guess maybe we could start.
Thanks. Thanks. Very, very informative. Have you talked to the GSEs and FHFA about this, and what do they say?
Yeah, so we presented this at Freddie Mac, and we are going to present it at Fannie Mae later this month. Sorry, no, at FHFA. Fannie Mae has not responded. I think that they're aware of these issues. I don't know if they can politically actually implement the solution we're suggesting, so they're in a bit of a bind. It's hard for the GSEs to pick and choose areas, like they are not allowed to price spatial risk, for example, because of the political challenges that they face. So I don't know.
Recommend, just based on the politics in the US, for them to, what would you recommend? If you were the head of
Yeah.
FHFA, what would you do?
I mean, luckily as an academic, I can say, I don't have to think about politics, but if you actually force me to think of something, I think I would still recommend counterparty risk pricing. Because this is not, Miami's paying a higher price. Having Miami pay a higher price is politically a non-starter, but having like Magnolia Insurance Company pay a higher, mortgages backed by Magnolia have to pay a higher price is more palatable because you can see that they're very undercapitalized. So I actually still think it will be our solution. We'll see what they do. Mhm.
Hi,
Mhm.
Mike Weinberg, also a Stern alumnus and also a Columbia Business School professor. So who are these Demotech insurers? Like, who are they capitalized by? Like, how many are there? What's the raison d'etre there? Like, could you give a little more color on that?
Yeah. So I mean, this is where we have to get a bit more anecdotal because we don't have great information on the organizational structure of these insurance companies. Most of them are private, they're not publicly traded, etc. When you look at at least when you look at the ones that went insolvent, those are the companies that we have the most information for. These are companies that tend to be standalone companies in groups with just one or two other insurance companies. And we actually see a lot of evidence of expropriation. So the CEO and a few people tend to get really high payment, like high wages, I guess. And they tend to use third-party vendors that are also associated with people in the same family, like their own family. And they're charging above market prices for services. So a lot of this, I don't want to paint a broad brush. I'm not saying,
Frauds or scams
it's an expropriation. I don't see market discipline by shareholders offsetting some of this.
Yeah, thanks.
Mhm. Yep, I think there's a question in the back.
So thank you. I really enjoyed your paper. My name is Mark Brown. I'm at the Greenberg School of St. John's University, close by.
Mhm.
So my question is this. I think you mentioned that there are 3 rating agencies that are allowed. Demotech, I think you had as 1990 was their origin, or 1990s.
Yes.
I believe there are some other rating agencies also.
Mhm.
Have you looked into how Demotech was approved?
So 2 things. Now Fannie Mae and Freddie Mac have added a 4th rating agency, Kroll, and Fitch also has some role in this space, but I don't know, they're not accepted by the GSEs. And beyond that, there aren't actually that many providers of financial stability ratings for insurers. But to answer, I think, to be honest, I don't know, there's not much documentation, but when we talk to people, it seems like after Hurricane Andrew, a lot of the traditional insurers left. And if they had, if AM Best was rating some of the insurers that remained, they wouldn't have met the GSE thresholds with AM Best. And that helped to create Demotech. So it was created as a way to arbitrage the GSEs, which is fine if you're Florida, but if you're a taxpayer, like, yeah.
Thank you.
Mhm.
Great. Thank you so much. That's terrific.